January 14th, 2026. The United States Mint has done something it has never done in modern history. They've stopped selling silver, not because they ran out, not because of a technical glitch, but because they cannot price it anymore. The official statement reads, pricing adjustments due to rapidly rising silver prices. When a sovereign government entity, backed by the full faith and credit of the Treasury, cannot figure out how to price a 1-ounce silver coin, so what does that tell you about the currency itself? This isn't a pause, this is a confession. And if you understand what just happened here, you're about to witness something the financial establishment has denied for 50 years. Welcome to Benji Sykes. If you've been in business long enough to remember when a handshake meant something, when contracts were honored, when the dollar actually held its value from one decade to the next, then you understand why this channel exists. We don't do hype here, we do analysis. If that resonates with you, I'd appreciate if you'd subscribe. Think of it as keeping this research desk funded, and drop a comment below. Tell me where you're watching from. New York? London? Singapore? Let's see how global this audience really is. Now, let's break down what just happened. On Wednesday, January 14th, 2026, a government employee at the United States Mint logged into the system and updated the official website. The message was brief, professional, almost forgettable. Due to rapidly rising silver prices, the United States Mint is temporarily suspending all sales of silver numismatic products until further notice. Most people scrolled past it, but a small group of analysts sat up straight because they understood what they were looking at. This was not a routine maintenance notice. This was a white flag. The United States Mint, the official manufacturer of American coinage, had just admitted it could no longer perform its basic function. It could not price silver. Think about what that sentence actually means. The Mint is not a startup, not a day trading firm, not some speculative hedge fund trying to time the market. It is a government entity with access to Treasury data, wholesale suppliers, and decades of operational experience. If they cannot price a 1-ounce silver coin in real time, something fundamental has broken. The official explanation sounds reasonable at first glance. Rapidly rising silver prices. Fair enough. Markets move, prices fluctuate, adjustments need to be made. But here is where the story gets uncomfortable. The Mint has dealt with price volatility before. In 2011, silver hit nearly $50 per ounce. The Mint kept selling. In 2020, during the pandemic chaos, premiums spiked to historic levels. The Mint kept selling. They rationed products, they delayed shipments, but they kept pricing and selling. So why stop now? The answer lies in a problem most businesses never have to face. Inventory replacement during parabolic price movement. Here's how it works. When the Mint sells you a silver eagle today, they collect dollars, but they lose an ounce of physical silver. To stay in business, they need to go back into the market and replace that ounce. In a normal market, this is straightforward. They buy silver from refiners at the spot price, add their manufacturing costs, add their markup, and the system functions. But what happens when the price gaps violently overnight? What happens when they sell an ounce at $100 and the next morning the replacement cost is $115? They have just traded a hard asset for depreciating paper currency. And if this pattern continues day after day, they are effectively liquidating the national metal reserves at a loss. This is not speculation. This is basic accounting. The Mint realized they were bleeding real wealth, and they stopped the hemorrhaging. But there is another layer to this decision that most observers are missing. The suspension reveals something darker about physical supply. If the Mint were confident they could buy replacement silver easily in the open market, they would simply raise their prices and keep selling. Businesses do this all the time. Oil companies, wheat distributors, copper suppliers, they all adjust prices during volatility and continue operations. The fact that the Mint chose suspension over repricing suggests they are not confident replacement inventory exists at any reasonable price. Or worse, that it exists, but they cannot access it fast enough to prevent losses. This is the signature of a physical shortage masquerading as a pricing problem. When a seller refuses to sell during a price spike, it usually means they cannot replace what they sell. And when that seller is the United States government, it means the paper price on the screen and the physical reality in the warehouse have diverged beyond reconciliation. Now, some will argue this is temporary, that the Mint is simply being cautious, that they will resume sales once the market stabilizes. Perhaps. But history teaches a different lesson. When sovereign entities suspend market operations due to pricing difficulties, they are rarely quick to return, because the pricing difficulty is almost never the real problem. The real problem is that the monetary system itself is being repriced, and no government bureaucracy can move fast enough to keep up with that. The suspension notice sits on the website today, bland, bureaucratic, unremarkable to most, but to those who understand monetary history, it reads like a distress signal. The question is no longer whether the system is under stress. The question is what comes next. There is a moment in every financial crisis when the authorities believe they are being subtle. They think a carefully worded press release, a technical pause, a temporary adjustment will go unnoticed by the general public. They are usually right. Most people do not read Treasury Department notices, do not track mint operations, do not study the footnotes of monetary policy. But there is always a small group watching: historians, analysts, the survivors of previous crises, and they recognize the pattern immediately because they have seen this movie before. April 5th, 1933. President Franklin Roosevelt signed Executive Order 6102. It required all Americans to turn in their gold coins, gold bullion, and gold certificates to the Federal Reserve. The penalty for noncompliance? 10 years in prison or a $10,000 fine. But here is what most people forget about that day. The confiscation did not come out of nowhere. It was preceded by months of quiet disruptions. Banks began limiting gold withdrawals in late 1932. The Treasury stopped minting gold coins in early 1933. There were administrative delays, temporary inventory adjustments, routine operational reviews. The language was always calm, technical, forgettable. And then one morning, the door slammed shut. Fast forward to August 15th, 1971. President Richard Nixon appeared on national television for a Sunday evening address. He announced that the United States would temporarily suspend the convertibility of dollars into gold. The Bretton Woods system, the foundation of post-war international finance, ended that night. But again, this was not a surprise to those paying attention. Throughout 1971, foreign central banks had been draining U.S. gold reserves. France sent a battleship to New York Harbor to collect its gold. The Federal Reserve was hemorrhaging metal. By summer, Treasury officials knew the math did not work. They could either defend the gold peg and run out of reserves, or they could break the promise and save what was left. They chose survival. The word temporary in Nixon's speech. 55 years later, that suspension is still in effect. Now jump to January 1980. Silver hits $50 per ounce. The Hunt brothers, billionaire oil heirs from Texas, had been accumulating massive silver positions, trying to corner the market. The commodities exchanges panicked. On January 21st, 1980, the COMEX changed the rules mid-game. They implemented Silver Rule 7, which limited trading to liquidation orders only, no new buying allowed. The price collapsed, the Hunts went bankrupt, and the market stabilized. But here's the detail that matters today. Before the exchange, suspended trading, there were weeks of unusual delivery delays. Refiners could not keep up with demand. Vault inventories were draining. The paper market and the physical market were splitting apart. Rule change was not about the Hunt brothers. It was about the fact that the exchange could not deliver the metal it had promised. Move forward to 2008. The financial crisis hits, credit markets freeze, banks fail, currencies wobble, and quietly, almost unnoticed, the United States Mint begins rationing silver eagles. They do not suspend sales, but they limit dealer allocations. One dealer who normally received 10,000 coins per week suddenly received 2,000. Premiums exploded. A silver eagle that should have sold for $2 over spot was selling for $6, $7, $8 over spot. The Mint claimed it was a production capacity issue. But the real issue was simpler. Demand for physical silver had overwhelmed their ability to manufacture and distribute it, and rather than admit the system was broken, they rationed it and hoped the panic would pass. It did, eventually, but the pattern was established. Do you see it yet? Every monetary crisis follows the same sequence. First, quiet disruptions, delays, administrative pauses, then rationing, allocation systems, temporary rule changes, then full suspension, market closures, emergency executive orders, and finally, a new set of rules that no one voted for and few understand. The language is always calm. The officials always promise it is temporary. And the public always believes them until they do not. Here is what makes January 14th, 2026 different from a routine operational pause. The Mint is not rationing. They are stopping. They are not limiting allocations. They are refusing to price. This is not step 1 or step 2 of the crisis sequence. This is step 3. And historically, step 3 does not last long, because once a government entity admits it cannot perform a basic market function, political pressure mounts, Congress asks questions, the media starts digging, the public gets nervous. And when governments get nervous, they do not restore free markets. They impose controls. The pattern has repeated across decades. across continents, across different metals and currencies, but the outcome is always the same. Temporary becomes permanent. Adjustments become confiscations, and those who saw it coming position themselves accordingly. While those who trusted the official language wake up one morning to find the rules have changed, the United States Mint suspension is not an anomaly. It is a chapter in a very old book, and anyone who has read the previous chapters knows how this story tends to end. There's a question Wall Street analysts hate to answer. Where is the actual metal? Not the paper contract, not the futures position, not the ETF share certificate, the physical ounce, the bar sitting in a vault somewhere with a serial number and a weight stamp. Where is it? And more importantly, can you actually get it? This question makes people uncomfortable because the modern financial system is built on a convenient lie. And the lie that paper and physical are the same thing, that a contract promising delivery is equivalent to possession, that liquidity on a screen equals availability in the real world. For decades, this lie worked beautifully. Until January 14th, 2026, when the United States Mint accidentally told the truth. They cannot get the metal. Let's walk through why. Silver does not appear out of thin air. It starts deep underground, in a mine somewhere in Mexico, Peru, China, Australia. A mining company spends 3 to 7 years exploring, drilling, permitting, and building infrastructure before the first ounce comes out of the ground. That silver ore gets crushed, processed, refined into 99.9% pure bars. Those bars get shipped to a refinery that melts them down and molds them into standardized forms. Then they go to a fabricator, like the US Mint, who stamps them into coins, medallions, or industrial components. Finally, they reach a distributor, then a dealer, then a customer. This entire chain takes time, infrastructure, energy, and expertise. You cannot speed it up with a phone call. You cannot print it with a policy announcement. And you certainly cannot create it with leverage and derivatives. Now here is where the story gets interesting. For the past 2 decades, industrial demand for silver has been quietly devouring supply. Solar panels require silver paste for conductivity. Every smartphone has silver contacts. Electric vehicles use silver in their charging systems and battery management. 5G infrastructure, medical equipment, water purification, aerospace components, all of them need silver. And unlike investment demand, which ebbs and flows with market sentiment, industrial demand does not stop. A solar panel manufacturer in China does not care if silver is expensive. They need it to fulfill their contracts. So they pay the premium, lock in supply, and pass the cost downstream. This creates a peculiar situation. Investment buyers compete with industrial buyers for the same limited supply. But industrial buyers have deep pockets, long-term contracts, and no choice. Investment buyers have options, price sensitivity, and the ability to walk away. Guess who wins that bidding war? Now add another layer. The COMEX, the Chicago Mercantile Exchange where silver futures trade, operates on a fractional reserve model. For every 100 ounces of silver traded on paper, there might be 5 ounces of physical metal in the vault, maybe less. This works fine as long as most traders settle in cash and never ask for delivery. It collapses the moment too many people show up demanding the actual metal. And lately, more people have been showing up. In 2023, registered silver in COMEX vaults dropped to a 20-year low. In 2024, delivery demand spiked during geopolitical tensions. By early 2025, the spread between paper price and physical premium began widening. A silver futures contract might trade at $30 per ounce, but if you wanted actual coins delivered to your door, you paid $38. That $8 gap is not a dealer markup. It is the market screaming that paper and physical have decoupled. Now, imagine you are the United States Mint. You need to buy silver to manufacture coins. Where do you buy it? You could go to the COMEX and take delivery, but that requires navigating a complex market with limited physical inventory. You could go directly to refiners, but they are already committed to industrial contracts. You could import from overseas, but international premiums are even higher. Every option involves either paying a massive premium or waiting months for delivery. And here's the trap. If the Mint sells you a Silver Eagle today for $100, but they have to pay $115 to replace that ounce 3 months from now, they are losing $15 per transaction. Multiply that across millions of coins, and you're looking at hundreds of millions in losses. No government accountant will approve that math. So they have 3 choices. 1, raise prices dramatically to cover replacement costs, but risk public backlash and accusations of profiteering. 2, ration supply and hope demand cools, but they already tried that in previous crises, and it only delayed the problem. 3, suspend sales entirely and wait for the market to stabilize. They chose option 3. But here is what they are not saying publicly. The market is not going to stabilize, not in the way they hope. Because the problem is not temporary volatility. The problem is structural deficit. For years, annual silver mining production has been around 830 million ounces. Annual demand? Over 1 billion ounces. The difference gets made up by recycling, government stockpile sales, and inventory drawdowns, but those sources are finite. Government stockpiles from the Strategic Silver Reserve were sold off decades ago. Recycling has limits, and inventory, it is vanishing. The silver that used to sit in dealer vaults, refinery warehouses, and exchange depositories is being absorbed into industrial products that will never return to the market. And once silver goes into a solar panel installed on a roof in Germany, it is gone for 25 years. Once it gets embedded in a medical device, it is not coming back. This is not a liquidity crisis. This is a disappearance. And the United States Mint just admitted, in the most bureaucratic language possible, that they cannot find enough metal to keep their operation running. The paper market says silver is $89. The physical market says it is unavailable at any price the mint is willing to pay. When those two realities collide, the system does not adjust smoothly. It freezes. And frozen markets have a very predictable outcome. Someone, somewhere, rewrites the rules. There's a difference between knowing something intellectually and understanding it operationally. Every business student learns about supply and demand curves. Every finance professional understands the concept of market dislocation. But very few have ever lived through a moment when a sovereign government admits it cannot perform a basic commercial function. That moment is not theoretical anymore. It happened, and it carries implications that most decision makers have not yet processed. Let's start with the most immediate question. What does this mean for businesses that depend on commodities? If you run a manufacturing operation, a jewelry company, an electronics firm, or any enterprise that uses physical materials in production, you just received a warning. The warning is this: your suppliers may not be able to deliver at contracted prices, or worse, they may not be able to deliver at all. When the United States Mint, with all its resources and government backing, cannot secure inventory, what makes you think your suppliers can? The prudent move is not panic. It is reassessment. Call your suppliers, ask about their inventory depth, ask about their sourcing, ask how long they can sustain current delivery schedules if prices continue rising. Do not accept vague assurances. Get numbers, get timelines, get contract language clarified, because the businesses that survive commodity shortages are not the ones with the best intentions. They are the ones with the most secured inventory. Now expand that thinking beyond silver. This suspension is not happening in isolation. Copper inventories at the London Metal Exchange have been declining. Nickel markets experienced violent squeezes in recent years. Lithium prices have been erratic. Rare earth elements remain controlled by a handful of countries. The pattern is consistent across the commodity complex. Physical supply is tightening while paper markets pretend everything is liquid. For corporate treasurers, this creates a strategic dilemma. Traditionally, companies hold cash for flexibility and liquidity. But what happens when cash loses purchasing power faster than it earns interest? What happens when the dollars in your Treasury account cannot buy the materials you need next quarter? This is not a hypothetical anymore. It is a board-level strategic question. Some companies will begin holding inventory as a Treasury asset, not for production, but as a store of value. Others will negotiate long-term supply contracts with fixed prices, locking in costs before inflation accelerates further. The companies that hesitate, that wait for certainty, that trust the market will normalize, will find themselves bidding against competitors who acted earlier. And in a genuine shortage, early action is everything. Now, let's talk about what this means for individuals. Most people hold their wealth in bank accounts, retirement funds, and real estate. These are paper assets, or assets denominated in paper currency. When a government cannot price a physical commodity, it is signaling that the paper measuring stick itself is unstable. Think about what a dollar actually represents. It is a claim on future goods and services, a promise that you can exchange it for something real later. But what happens when later arrives and the shelves are empty? What happens when sellers refuse to accept the currency because they cannot replace what they sell? The dollar does not collapse in a dramatic crash. It dies quietly through unavailability. You can have $1 million in the bank, but if no one will sell you what you need, the money is worthless. This is why physical assets matter. Not for speculation, not for trading, but for optionality. Holding something tangible means you are not entirely dependent on the monetary system functioning correctly. And right now, the monetary system is sending distress signals. But here's the critical distinction. This is not advice to panic, to liquidate everything, to become a survivalist hoarding canned goods in a bunker. That is emotional reaction. What is needed is strategic positioning Ask yourself these questions. If the currency continues losing purchasing power, what do I own that will retain value? If supply chains tighten further, what do I need that might become scarce? If government policies shift suddenly, what assets are most vulnerable to intervention? These are not predictions. They are contingency plans. The businesses and individuals who prepare for multiple scenarios always outperform those who bet everything on a single outcome. History provides the roadmap. In every monetary transition, certain patterns repeat. Governments initially deny the problem. Then they implement temporary measures. Then they impose controls. Then they reset the system with new rules. The wealth transfer happens between step 2 and step 3. Those who recognize the transition early move their assets accordingly. Those who wait for official confirmation find themselves trapped in the old system as it collapses. The United States mint suspension is step 2. It is the temporary measure phase. What comes next depends on how severe the underlying shortage becomes. If supply stabilizes, the mint reopens, and life continues with higher prices but functioning markets. If supply worsens, rationing expands, premiums explode, and political pressure builds for intervention. And if the shortage becomes systemic, the government will rewrite the rules entirely. No one knows which scenario will unfold, but only one of those scenarios allows you to operate in a free market. The other two involve controls, restrictions, and mandated outcomes. So the strategic question is simple. Do you position yourself while you still have choices? Or do you wait until your options are dictated by emergency policy? For business leaders, this means securing supply chains, diversifying currency exposure, and holding real assets alongside paper ones. For individuals, it means understanding that wealth is not just a number in an account. It is access to resources when you need them. The mint suspension is not the crisis. It is the early warning. The actual crisis comes when everyone realizes simultaneously that the paper system and the physical world have diverged. And by then, the repositioning window is closed. Right now, that window is still open. Most people are not paying attention. Most analysts are dismissing this as a temporary operational issue. Most institutions are waiting for clarity before acting. That is the opportunity, not to outsmart the market, but to simply recognize what is already happening. The United States government just admitted it cannot price silver. That sentence should not exist in a functioning monetary system. The fact that it does tells you everything you need to know about what comes next. The only question left is whether you will adjust your strategy accordingly, or whether you will wait for the official announcement that the rules have changed. By then, the wealth will have already transferred from those who trusted the system to those who understood the signals.